The economy is growing, jobs are strong, and the unemployment rate just hit its lowest point in nearly a year. So why won't mortgage rates come down already? The answer? It lies in a room where 12 people make decisions that affects every buyer in America. And last month, 4 of them couldn't agree on where to take things next. Here's what you need to know. I'm Karl, your San Diego realtor, and this is your monthly mortgage market update with Matt.Kish from Movement Mortgage. Every month, we take a look at what actually moved mortgage rates, what the bond market is signaling, and what you need to be thinking about right now. And here's my promise to you with this entire series. There's gonna be no hype, there's no doom scrolling, and there's no outrageous predictions here. What I want you to walk away with is a very clear picture of what's happening, why it matters, and what your next move should be, whether you're buying, selling, or staying patient a little bit longer. Now, let's get into this. Here's where rates were at the making of this video. According to Mortgage News Daily, the 30-year fix is just sitting slightly above 6.5%, and the 15-year fix is a hair over 6%. Jumbo loans, which are your larger loans that exceed the standard conventional loan limit, those are sitting at 6.63%. For your government-backed options, FHA, VA, those are sitting at just a hair over 6% like your 15-year. And lastly, you have your 7/6 ARM, an adjustable rate mortgage that holds a fixed rate for the first 7 years before it can change. That's sitting at 6.25%. Let's recap how things panned out in April for the 30-year fix. Rates opened the month around 6.45%. They drifted down to a low of 6.30% in the third week of April. Then they spiked back up to nearly 6.5% right at month's end. That spike landed on the same day as the Federal Reserve's April meeting and a fresh round of inflation data. Rates have pulled back slightly since and are sitting still around 6.5% with just micro adjustments here and there. The forecast from last month, rates holding between 6.3 and 6.7%, that held up exactly as we predicted. Here's a quick note on inflation because it contributed to that end of month spike. We have PCE, it stands for Personal Consumption Expenditures. In plain terms, it's a measure of how much the prices of everyday goods and services, things like grocery, gas, rental, and medical costs, it measures how much they've gone up over the past year. The Federal Reserve watches this number more closely than any other inflation gauge because it reflects the broadest picture of what Americans are spending their money on. In March, PCE came in at 3.5% year over year, up from 2.8% when we filmed last month's episode. That means prices are 3.5% higher on average than they were a year ago, well above the Fed's 2% target. The energy piece of that increase is tied to the situation in Iran, which we covered in depth last month, so we'll leave that context there and just keep moving on. And then there's this affordability number that doesn't get enough attention. Year-over-year affordability improved 5.6% nationally, and that's because earnings grew faster than payments over the last 12 months. March was a step backwards, but based on the data, the 12-month trend is still in your favor, so the data says. Now, always keep in mind, these are national averages. Your actual rate depends on your credit score, your down payment, the loan type, and how your lender is pricing right now, which is a good time to hear from Matt.Kish over at Movement Mortgage. I asked Kish what he's seen from buyers sitting across from him right now. Have people made peace with rates in the mid 6% range? And are they ready to move? Or is there still hesitation? Are buyers holding out, waiting for something lower before they commit? Let's hear what he has to say.
Great question, Karl. Short answer, they have not made peace. There's still a great deal of hesitation out there, especially since this conflict in the Middle East has started and people have really started seeing the squeeze elsewhere, right? At the gas pump, the grocery store, making things difficult to maneuver around just basic needs, right? If you got to take a 20-minute drive to work, that just got significantly more expensive overnight. So with that and with this, the economic news, rates have slightly ticked up and ticked up and ticked up. And now we're back into a range where we were, last year, right? We kind of lost the momentum we had coming into this year. So the buyers are kind of seeing that too. Affordability is a real word with real life consequences when it comes to buying a home in San Diego, and when you're feeling the crunch everywhere else. And if you're trying to buy a new place, or if you're trying to level up and it's not, life, you're dealing with life things that are forcing you to move out, like death, divorce, deployment, things like that. If you're just trying to, purchase that bigger place because your family's growing, a lot of people are sitting tight just because they're waiting for this squeeze to loosen up a little bit. And, we're kind of stuck where we're at until we see something different as far as the conflict over there.
Next, the Fed's leadership transition and what investor uncertainty does to your mortgage rate. First, let's start with building some context because this section involves a few terms that get thrown around a lot without much explanation. And once you understand them, the mortgage market starts to make a whole lot more sense. The Federal Reserve is America's central bank. It's the institution that controls the baseline cost of borrowing money across the entire country. Every 6 or 7 weeks, a committee of 12 people called the FOMC, the Federal Open Market Committee, they meet and vote on whether to raise, lower, or hold the benchmark interest rate. That rate is the foundation of borrowing costs across the entire economy. When it goes up, borrowing gets more expensive. When it comes down, it gets cheaper. Mortgage rates aren't directly tied to it, but they are heavily influenced by the direction it's heading. On April 29th, the FOMC voted to hold that rate right where it's been, between 3.5% and 3.75%. That was the third hold in a row, and the markets expected it. What nobody quite expected was the vote. 8 members voted to hold, and 4 dissented. The last time the Federal Reserve had 4 dissenting votes was back in October of 1992, over 33 years ago. And the dissent went in 2 completely opposite directions at the same time. 1 member voted to cut rates right now, believing that the economy needs the relief. 3 others were fine with holding, but they objected to even a hint in the statement that future cuts were a possibility. That's not a disagreement about timing. That's a philosophical split about the entire direction of policy. When the people running monetary policy for the entire country are divided like that, investors take notice. And when investors get uneasy, they reprice risk. We'll explain what that means for you in your rate in just a moment. Then there's this. Chairman Jerome Powell's term as Fed chairman ends May 15th, less than 2 weeks away from now. And Kevin Warsh is stepping in as the incoming chair. Powell has served since 2018. He guided the Fed through the pandemic collapse, the fastest rate hike cycle in about 40 years, and the long effort to bring inflation back down towards that 2% target. Kevin Warsh is a different figure, known more as market-oriented and more willing to move quickly. Investors are still sizing him up until they have a clear read on how he'll operate under pressure. That uncertainty gets baked into the bond market. Here's why this matters for your mortgage. Your rate doesn't follow the Fed's benchmark directly. It follows the yield on the 10-year US Treasury note, essentially the return investors earn on government bonds. When investors feel confident about the Fed's direction and the economy, they accept a lower yield on those bonds. When they're uncertain about a new chairman, a divided committee, or where inflation is heading, they demand a higher return. Higher treasury yields mean higher mortgage rates. The Fed's credibility is directly priced into your monthly payment. The CME FedWatch tool, which tracks where professional money managers are placing their actual bets on the upcoming rate decisions, well, it shows the June 17th meeting at a 96% probability of another hold. Near term, nothing's gonna change. But look out to December and something is beginning to shift. There's now a 12% probability of a cut by year end, up from 5% only a few weeks ago, and over a 30% chance that rates will go up. Investors are beginning to crack the door open on the possibility of relief later this year, while also trying to balance risk with the unknown impacts on the horizon for inflation. How far that door swings in either direction depends largely on what Kevin Warsh signals as the new chair and what the economic data between now and then has to say. Now, I asked Kish what this Fed uncertainty and leadership transition means at the lender level, how it's showing up in rate pricing, and what he'd tell a buyer trying to decide whether to lock a rate right now or wait for more clarity. Let's go ahead and hear what he had to say on all this.
Well, if it's going to be telling the way we're going with this new Fed, this past Fed day was tumultuous, to say the least, in the markets. It had some to do with the Fed day and a lot to do with the conflict overseas and the particular day news was coming out. But with Jerome Powell staying, Kevin Warsh kind of in the air. He'll probably be nominated, but there's still a lot of criticism behind him. And also, And with Kevin Warsh being sworn in and the economic squeeze from this war, there's still so many questions that have to be answered. And now the Fed's kind of saying they're not going to be cutting rates probably anytime soon. Maybe fourth quarter of this year is the projections, but the Fed may not cut their rate at all this year, right? So what does that look like? So I think until oil, hovers towards $80 a barrel again, we're going to see this whole Fed, economic, interest rates, we're going to see this bubble that we're in right now remain until we see something move, not only with the Fed cutting their rates, Warsh being actually sworn in, but also the conflict overseas. That's kind of driving the ship right now, and everything else is kind of secondary. Again, the Fed day last week was a gross day out there for people like me in my profession. The markets really reacted negatively, Fed day, but we were kind of expecting that, and a lot of pricing was already kind of baked in. But again, we're losing these kind of battles this last couple months, and we haven't had many wins. We've seen a lot more rate locks coming out from our technicals and our support than we've seen in a long time. Like, I haven't seen this many alerts to lock interest rates, in a couple of years, as far as the timeliness of them and how fast we're getting them. So I'm really hoping that we get some consistent good news coming out of the Middle East. That way we could kind of trend the other way and people feel a little more optimistic about what's going on, not only with the Fed, but in their own pocketbook. Now
let's address the hot topic of the jobs market, the number that's keeping the Fed's hands tied. So unemployment came in at 4.3% in March, and back in November, it was at 4.6%, one of the higher levels we've had in a while. Since then, it's been pulling back month after month, and then the March jobs reports, which released in April, showed that we had 178,000 new jobs added. Economists had forecasted just under 60,000. The labor market came in triple what the experts expected. Now, here's why a strong jobs market keeps your rates higher. The Federal Reserve has two mandates. Number one, to control inflation. Number two, to keep employment healthy. When people are losing jobs and the economy is struggling, the Fed has a reason to cut rates. They make borrowing cheaper, get people to start spending money, and that gets the economy moving again. But when the jobs market is strong and people are working, there's no real emergency. The Fed can afford to wait. A Fed that's waiting is a Fed that's not making any cuts. The broader economy backs this up. GDP, gross domestic product, the broadest measure of how the economy is growing, that expanded to 2% in the first quarter in 2026. Not explosive, but positively solid. And it happened during elevated oil prices, war-driven supply chain disruption, and persistent inflation. An economy that can absorb all of that and still grow is not one the Fed feels urgency to rescue. The April jobs report releases May 8th, shortly after this video drops. That number will be one of the more closely watched data points between now and the June 17th Fed meeting. I asked Kish to break down how this jobs picture affects the rate outlook going forward. If the labor market stays this strong, what does that timeline look for buyers hoping to see lower rates? And what has to change before the Fed feels it has permission to make a move? Let's take a listen.
Well, Karl, that's kind of a weird question, right? Because history, and especially recent history, has kind of told us, don't react to the first jobs numbers. Watch what it and they become, right? Is these initial jobs numbers have all sounded really tasty for about 17 months now. The initial jobs numbers come out like, whoa, big growth. And then we see the next month and then the following month, these numbers being revised down to nothing, right? We're getting 1/10 basically of what's being reported initially as actual job numbers. And 2025 was a clear example of that. It was almost exactly about 1/10 of what we were being reported initially actually came to fruition. So I would really pump the brakes on thinking that we're kind of trending that direction. We're flat. Jobs numbers are flat. Nobody's really getting laid off and nobody's really gaining any jobs. Most people, especially since COVID, have kind of just stayed right where they're at, right? There hasn't been much growth up or down, left or right. So until that starts happening, these jobs numbers are always gonna be revised down to kind of nothing. And if you've heard me say it before, you've heard me say it a billion times, is until there's some kind of policy driving the economics behind us, we're kind of just going to be in this quagmire of good news, bad news, right? And it's going to be just kind of touch and go. There's nothing economically right now that's going to drive us towards lower rates other than, oil being lower, the conflict overseas having a cap to it, and that way consumers over here kind of know that we're going back to normal. Farmers, fertilizer, that's going to be a big thing too. So at the end of the day, I would really be wary of these initial job numbers and look at what they become next month, the month after. And if you see the trend staying, then man, we're on our way, but it hasn't been the case in almost a year and a half. So I hate to, burst the optimistic bubble, but I'm just not so optimistic when it comes to these numbers.
Here's my honest read on where things stand. The Fed is holding, the jobs market is strong, inflation is still above target, rates are roughly 6.5% today, and the same headwinds from last month are still present. What has changed is this. Investors are beginning to price in the possibility of rate cuts and hikes by the end of the year. That's not a guarantee, it's a signal that the market is considering all possibilities right now because of all the unknown factors. How it pans out depends on Warsh's signals as the new chair and whether the data corresponds or correlates. If you have questions about your rate, getting pre-approved, or what you can qualify for in today's market, reach out to Matt.Kish at Movement Mortgage. Just reach out to him directly. His contact info is in the description below. He's the lender behind this entire series every month, and he knows this market. If this update was useful, hit the like and subscribe button. We put this material out every month so you always know what's happening before it affects your decision. As always, I'm Karl, your San Diego realtor. I'll see you in the next video.